Good afternoon, everyone. My name is Will Stringer, founder, CEO of Chisos Capital. And what we do is similar to venture debt, but it's really for individuals. So we like to say that we are investing in human ventures. And this is fairly unique, probably not something you've ever seen unless you've seen this conversation at Marty's other events. So first off, what is a human venture? So a human venture is a person pursuing huge economic upside. So if we define those classes of individuals, we're thinking about athletes, we're thinking about founders, we're thinking about creatives. Athletes pursuing the top of their sport, they're trying to get to the pro league. That's a huge economic upside for them if they actually make it. Founders, they start a company. If they actually succeed, again, huge economic upside. Same with creatives. You become a world famous artist, huge economic upside. All of those individuals need capital in the beginning to get started though. And that's where we're coming in. We're coming in providing today up to $50,000 of initial capital to get started. Now, this whole idea of investing in people is kind of a broader platform play that I'll go into as well, where we're trying to facilitate these types of investments into individuals outside of our own capital. And so I'll go into that. But first, so the creation of our instrument, the convertible income share agreement, was really designed for myself when I started the business, like any good entrepreneur. What happened was, quickly, my background is finance and investing. Started out in Houston, Texas at BofA Merrill Lynch in the oil and gas banking group. Went over and worked for a single family office in Houston, the Cockrell family, worked on their investment team for about 4 years. Then decided to pivot a little more into early stage adventure. Moved out to California, currently reside in Los Angeles. Worked at a fintech for about 9 months. That fintech actually imploded and found myself unemployed essentially. I decided at that point to start my own company. There's entrepreneurship in my family, decided let's give it a try. So I put a little bit of my own money into it and wrote down a kind of a napkin sketch idea of let's invest in early stage entrepreneurs and let's figure out how to protect our downside. Very vague. The people I went out to, people I know, some colleagues, friends, family, I asked them to invest in my company. One, to get a little bit of money in the door, and two, to just get them bought in, get people bought into what I was building and they could support me and help me. Well, rightfully so, they told me, you don't really have a company, you have a napkin sketch with an idea. I'm not going to invest until you have a little bit more there, which was totally fair. These individuals were more real estate, oil and gas, private equity, more conservative type investors, not really the angel type or the venture type that are the ones writing those kind of believe in a dream checks. And so that was kind of the aha moment of, okay, well, these people have money and they want to invest, but they're not really investing in this napkin sketch idea. So how do I make this less risky for them? I basically had come across this idea of an income share agreement that summer of 2019, decided to incorporate that into the offering. So I basically went back to them and said, all right, why don't you invest in my company, but I'll personally guarantee it in a way with this income share agreement. So you get equity in my company and you get an income share agreement backed by my future earnings, my personal income. So if my company fails, I'll pay you back as I make money. You know me, you've seen my career, your bet is that I will make money and pay you back. But if my company actually succeeds, then you're an equity holder. Good for you. You have two ways to win with low downside protection or low downside risk. So that was the first deal that got done. It was my own deal. We basically took that idea and turned it into Chisos Capital, which is us raising our own funds to go make those types of investments in other entrepreneurs. Entrepreneurs across the United States with high earning potential, usually with somewhere between 3 to 10 years of previous earning income history so that we can underwrite that. And they're starting a business. They've put in some of their own money, maybe some friends and family money. Maybe they're not quite to MVP or revenue traction yet, and they need some more money. So that's where we'll come in with a small check, but also with some support. We have our own network as a company. My partner's 20 years in the venture industry and software industry. and we'll provide a little bit of guidance around them on how to actually build a company. So we've been doing that now for about 2.5 years. We've made about 50 investments across 50 individuals across about 45 companies. We're now collecting about $15,000 a month in ISA payments, which is increasing month over month as more individuals start earning money because they either go back into the corporate world after their company fails, or they raise their next round of capital for their business and they start paying themselves a salary. So this model is working. We're scaling this model up. And again, we've got about 50 equity stakes in early stage companies. About 9 of those have gotten equity markups so far. Our kind of most advanced one, again, we're investing kind of pre-seed, so they're all really early. Most advanced one is raising their Series A in the next few months, and we'll now see how that goes as new, fresh turmoil is starting into the industry. Since we are in Texas, I like to basically analogize it to royalties, mineral and gas royalties, oil and gas royalties. The royalty on our investment is basically a royalty on a person's future earnings. So if you think about an oil and gas royalty, the cash flow actually goes up and down based on the price of oil, based on the price of gas, based on a number of different things. So instead of it being a fixed income where you get the same amount, principal and interest every month as payment, your payments fluctuate. Well, that's the same as the payments that we receive as an investor and as a holder of this income share agreement with the individual. As an individual starts earning more money, their payments to us go up. As an individual starts earning less money, or if their income goes to zero, their payments stop or they reduce. So that's why it's attractive to entrepreneurs or individuals, because it's flexible. It's also available because we're one of the only people providing capital in this early stage market. So I'll give you 3 examples that we've either completed the investment or we're looking at it. So very first one, ag tech entrepreneur out of New York. This actually happened right in the beginning of COVID. And so we were fortuitous that she needed capital. We were able to step up with a $50,000 investment. We got about 1% of the company, and we got this income share agreement. Well, this founder has gone on to raise about $2 or $3 million bucks. She just got a $4.5 million grant. And so she's building her company, and that company is succeeding. Well, from day one, she's been making payments to us because she pays herself a salary from the company. So that investment for us has been cash flowing since day one, and we have an equity stake that continues to increase in value as the company grows. Now, I mentioned athletes earlier. Athletes is another individual class that we've started to move into. Again, athletes, you think about golfers going through Q school, you think about minor league pitchers. They really don't make any money while they're trying to make it to the top. And it's expensive to train and travel and compete. And so what you'll see is a lot of these minor league sports individuals, they're getting funded maybe from their parents. Maybe they can do a club deal, if they're a golfer at their local country club. But there's a lot of individuals that really struggle. Parents have to take out a second mortgage. They go do these sharky loan deals with unsavory characters. This stuff happens. And so we see that as an opportunity where we can take our same type of capital that we've been providing to entrepreneurs and provide it to athletes. We get an income share agreement with the individual. So we are underwriting the individual and their future earning potential. Often there's not a lot of income history there. And so what we use as a proxy is the degree that they graduate with and the college they graduate with. And we kind of understand, all right, if you're a finance major from wherever, Stanford, we know you're going to be okay. And so we're going to make that bet on you. That's kind of our downside underwriting. And then obviously the upside is they make the pro tour, or they make the big leagues. And for us, there's not a whole lot of kind of stats and scouting of the individuals that go into it. We more rely on a scout network. So we started building relationships with agents, with scouts and other sports. We kind of rely on them sending us good deals, and we'll make the investment with the off chance that that individual makes it to the pro league. But at the end of the day, we've got our downside protected. We did make one of these investments so far in a minor league pitcher. Minor league pitcher, 6'5", left-handed. We'll know in a couple months here if he got signed to the 40-man roster for this upcoming season. If he does get signed, his minimum salary is going to be $750,000, and that'll be a 6x for us in about 18 months. Now, if he doesn't, maybe he goes through another season of the minors, maybe he tries again next year. Hard to know, but he's got a 4-year economics degree from a reputable college. The guy's going to be fine. Pretty safe bet for us. So I mentioned the broader platform idea here. So we started with raising our own funds and deploying our own capital. We quickly realized that the opportunity set here far outstrips the capital that we're able to raise. And so what we're building now is a platform to pull these deals together, to structure these deals, source these deals, bring the individuals that are looking for this type of capital, and then bring the investors that are interested in these types of deals, and then providing the software platform for those deals to happen. That platform is called Inspire, and fairly new platform, but just like I mentioned, we're looking for those types of deals to put on the platform. We're also looking for investors interested in reviewing those types of deals. Now, 2 deals that have already come through for Inspire. One is a visual artist, someone who makes paintings. She's got 5-10 years of track record of her paintings all selling for about 25 grand a piece. What she's trying to do right now is raise $150,000 to fund her operations for next year, so that she can kind of move in a different direction and what she thinks kind of break into the upper echelons of creative artists. And what we're talking with her on is basically forming a personal holdco and pledging 50% or up to 50% of all proceeds of her paintings or her artwork for the next 5 years. So it's a bit of an equity investment in the artist instead of actually purchasing the paintings. 50% of her proceeds, if her paintings start becoming very, very valuable in the next 5 years, then that ownership in that holding company becomes much more valuable. So again, kind of a creative way to raise money for the artist, but also an interesting way for the investor to get exposure to visual art through investing in the personal equity of an artist instead of just buying art. Another one, which a lot of people will maybe have opinions on here, is a vice president, kind of a mid to high level employee at a private equity firm. For a number of reasons, he's trying to raise about $500,000 to $1 million of capital for some personal things. What he's looking to do is form this personal holdco, contribute about 1/3 of his carried interest that he owns in this big private equity fund into the holdco, and then raise money from his network, about $1 million, so that he can have the cash and that those people can basically be betting on him and the carried interest of this fund. So it's a little bit of a unique deal, but it all fits within the construct of the platform that we're pulling together that is helping people do these individual unique deals and essentially sell equity in their future earnings. And if anyone has questions on any of this, definitely raise your hand. Okay. So our fund is a 10-year term. Cash flow is cash flowing day one with increasing cash flow. So 10-year term, we expect call it 1.8x return on the income share agreement payments to be returned about year 6 or 7. And then the equity component will take a little bit longer. These are very early stage companies, so we'll have the same type of long tail that many pre-seed funds have. It is essentially a 2 and 20 when you model it out, but we have an origination fee when we deploy the capital, and then we have a servicing fee when we collect the payments back in. But those all average out to about 2% per year. So instead of a 2% no matter what, it's fee when we deploy and then fee when we return the capital. And then we also have the 20% on equity.
Are you doing a life insurance hedge on the life?
No, there's no life insurance hedge. Yeah, there's no life insurance hedge. What was your question? Yeah, so we're calling capital all up front. It's a small fund. This is our second fund. It's $5 million, and we're deploying, very quickly, or as quickly as we can. So we're calling all the capital up front, and deploying it within 12 months at a minimum. There's no co-investment at the moment. Each deal is pretty small, so it's a $40,000 deal on average. So there's not a lot of juice there in order to kind of bring in a co-investor. Although this Inspire platform is along the lines of the co-investment, where say we don't have dry powder to actually do the deal in the fund, well then it'll go into the Inspire platform, and any investors that have indicated interest will see those deals, and they'll be able to participate in those deals. The actual returns to investors in our fund, targeting about 20 to 25% returns. About 2/3 of those returns are based on the income share agreement alone. So if every equity ownership piece goes to zero, you're still looking at a 12 to 15% type return. And again, there's current cash starting day one, and that cash actually increases over time, peaking in about year 4 or 5 before then kind of tailing off. And that's just because when we make an investment, about 60% of our individuals are not making income because they're working full-time on their business. Give it 12 to 24 months is what we've seen, and they either shut down their business, go back and get a job, or they raise their next round of capital and start paying themselves a salary. So that is an increasing cash flow over time. So the two opportunities right now with what it is we're building. One is our Fund 2, which is focused on entrepreneurs. We've got about $1.5 million raised. These minimum check sizes are about $100,000, so on the smaller end, and we plan to get that fully deployed this year. The other opportunity is the Inspire platform. So as I mentioned, this is kind of an earlier stage software platform that facilitates these same types of deals, acts as a curated type marketplace, definitely more of a venture type bet. And we're actually raising a small pre-seed for that as well. So it's not an open marketplace. So it's a little bit more like a syndicate. If you've ever participated in AngelList syndicates, basically sign up and say, hey, I want to see your deal flow, but you can't actually go on and see the live deals. We think, maybe year 3, 4, we'll have some more live deals and it'll look a little bit more crowdfunding like, but right now we're keeping it curated and keeping it all very private. It's usually between 1% and 4%. So it depends on how far along the company is, if it's a napkin sketch, or even we've invested in an individual that said, I want to quit my job and go try and start a company. I don't know what it's going to be like, or I don't know what company it's going to be. And we invested in him to quit his job and go explore for 6 months. On that one, we said, look, when you start your company, we're going to get 4% of it. He didn't end up starting a company, went back, got a job. He's now paying us back. So yeah, 1 to 4%.